All right, let's dive right into this because right now there is a massive, and I mean absolutely massive, paradox playing out in the financial markets of 2026. Millions of retail investors out there genuinely believe they are playing it safe. They're parking their hard-earned money in traditional fixed income havens, especially since the 10-year Treasury crossed that psychological 4% threshold. It feels good, right? But here's the catch. In reality, they are actively locking in a loss of their purchasing power. Today's explainer is going to show you exactly how this trap is working, why the traditional definition of financial safety has completely flipped on its head, and what the data says you should actually be looking at to protect your wealth. 4.36%. That is the nominal yield of the 10-year Treasury note as of early May 2026. Now, I know what you might be thinking. To the untrained eye, or maybe to someone still suffering from a bit of recency bias, this number feels like an absolute jackpot. Think back to the zero interest rate era of 2020, where bonds paid next to nothing. Coming out of that environment, locking in an absolute government-backed 4.36% appears to be an incredibly attractive, super safe harbor. It looks like a rock-solid, guaranteed return on your capital. But as you'll see, the data reveals this enticing number is actually a trap. Because when we strip away the illusion, here is the brutal, unvarnished reality. With headline inflation projected at a very sticky 4.2% right now, your actual real return on a $1,000 investment isn't $43.60. It is exactly $1.60. You are making a $1.60 in real income per $1,000 invested over a full year. And guys, that is before taxes and fees are even considered. That won't even buy you a single hash brown at a fast food drive-thru, let alone secure your retirement. You aren't playing it safe here, you are staying poor. This is a literal mechanism for wealth stagnation. So here is our roadmap to methodically deconstruct this yield trap today. We're going to cover 1. Unmasking the money illusion. 2. Geopolitics and structural inflation. 3. Calculating the technical value. 4. The inflation eraser math. And 5. The dividend alternative. All right, let's kick things off with part 1, unmasking the money illusion. The fundamental concept here actually comes from the legendary investor Benjamin Graham. The money illusion is basically this behavioral bias where we as humans evaluate our wealth in today's absolute dollars, completely ignoring the real-world goods and services that money will actually be able to buy in the future. We suffer from something called omission bias. Think of it like a leaky bucket. Most investors would rather watch the water slowly, quietly evaporate over time, which is that invisible loss to inflation, than actively try to plug the hole and risk spilling a few drops to market volatility. We are just psychologically wired to choose certain decay over uncertain growth. When we look at the actual yield data for May 2026, the cost of that guaranteed decay becomes super obvious. Just take the 10-year Treasury. It provides a nominal yield of 4.36%. Sure, but with expected inflation running at 4.20%, that real pre-tax yield shrinks down to a microscopic 0.16%. The 10-year Treasury is essentially sitting in a dead zone right now. Historically, bonds were meant to provide income and safety, but in our current environment, they provide neither. They function entirely as return-free risk. You are taking on the massive opportunity cost of tying up your capital for a decade with absolutely zero real growth to show for it. Moving right along to Section 2, Geopolitics and Structural Inflation. To really grasp why that 4.2% inflation number isn't just some temporary blip, we have to look at the macroeconomic reality of 2026. We are currently living through the most significant energy shock in decades. The outbreak of the Iran war initiated a massive, unprecedented supply disruption in the global oil market. Back in late February 2026, Operation Epic Fury began. By early March, the Strait of Hormuz was effectively closed to merchant traffic, which stranded roughly 20% of the world's seaborne crude oil and LNG exports. And by April, a U.S. naval blockade was fully implemented. This disruption spiked Brent crude to $126 per barrel. And you know how this works. When fuel prices surge this violently, every single item loaded onto an 18-wheeler gets instantly more expensive. It functions as a direct, unavoidable tax on global logistics and consumer spending. But energy is only half the story. We have a second major structural inflation driver right now, and that's the transformative 2026 tariff environment. This has created a permanent ratchet effect on core consumer goods. Now, a ratchet effect simply means prices crank up, they lock into place, and they stubbornly refuse to come back down. The latest round of global tariff implementations filtered incredibly fast through the economy, peaking in the first quarter and generating an estimated 0.8 percentage point increase directly to core PCE inflation. What this does is permanently devalue your currency's purchasing power on everyday items. With 25% tariff rates hitting major unavoidable categories like furniture and trucks, the data actually estimates an average total cost increase of $1,300 per household in 2026 alone. These tariffs operate as a sudden, one-time price jump that just cascades through the entire domestic economy. And nominal interest rates, they completely fail to account for this. Just think about it. How can a static 4.36% bond yield possibly defend your portfolio against a sudden mandatory $1,300 household tax and a massive spike in gasoline prices? Spoiler alert, it absolutely can't. Which brings us to Section 3, calculating the technical value. The gap between what the market expects to happen and what is actually happening is just staggering. If we compare TIPS, that's Treasury inflation-protected securities, against nominal Treasury yields, we can see exactly what the market is pricing in. The 10-year TIPS real yield is 1.94%, while the nominal yield is roughly 4.36%. The difference between those two numbers is what we call the break-even inflation rate, sitting at 2.45%. This means the bond market is currently pricing in this incredibly naive expectation that average annual inflation will just magically drop to 2.45% over the next 10 years. That expectation is completely decoupled from the current reality of a 4.2% spot rate, and it totally ignores the widespread Middle Eastern supply shocks and the aggressive new tariff regime we just broke down. We can actually prove the mathematical danger of this using the Fisher equation. In plain English, it simply states that 1 plus the nominal rate equals 1 plus the real rate, times 1 plus expected inflation. Basically, for your nominal bond to actually make you richer and outperform cash right now, inflation literally has to plummet well below that 2.45% threshold. It's like a seesaw. If inflation stays high, the real value of your fixed bond crashes to the ground. Given the structural damage to energy infrastructure and a super sticky core CPI, the probability of inflation miraculously dropping back down to 2% is historically low. Next up, Section 4, the inflation eraser math. Let's make this totally concrete. Imagine you invested $10,000 in early 2024 into one of those highly touted, safe 10-year treasuries. Fast forward 2 years, and your nominal account balance grows with interest to $10,872. On paper, hey, you feel like you've made a solid profit. But factoring in a cumulative inflation rate of over 7% by May 2026, the actual real purchasing power of your money has been absolutely decimated, down to $9,294. The inflation eraser completely wiped out your $872 in nominal interest and actually aggressively ate into your starting principal. This brings us to a quote from the research that bluntly, and I think perfectly states, a 4.36% bond is not an investment. It is a slow-motion default on your lifestyle. Treading water in a rising tide of costs means you are actively sinking. We are operating in a mini stagflation environment right now, where the 4% yield level is effectively the new absolute zero. If you aren't clearing 4% after taxes, your wealth is shrinking, period. Finally, let's look at some solutions in Section 5, the dividend alternative. So if traditional fixed income is a trap, how on earth do we escape it? Well, bonds suffer from what we call fixed decay. A treasury bond pays you a rigid $43.60 on the $1,000 investment until maturity. It cannot adapt to the world around it. High-quality blue-chip dividend stocks, on the other hand, offer inflation pass-through. These businesses possess vital pricing flexibility. When their supply chain costs rise during a stagflationary shock like we're in now, they simply increase their prices. This protects their profit margins, which in turn allows them to actively hike their dividend payouts to you. They use inflation as a tool rather than being destroyed by it. And we see this playing out perfectly right now in the energy and healthcare sectors. Take AbbVie, for instance. It yields 3.32% and successfully hiked its payout by 5.5% back in late 2025. People cannot simply opt out of their critical medications, right? Which gives companies like AbbVie the kind of inelastic pricing power that government bonds completely lack. Then you have enterprise products partners offering a robust 5.80% yield. Or Chevron, which yields 3.79% and is directly fundamentally benefiting from the $100 plus oil environment that is driving up costs everywhere else. These companies don't just survive supply shocks, they capture the inflated revenue and pass it directly back to the shareholder. The entire definition of financial safety has fundamentally shifted beneath our feet. Relying on a 4.36% nominal return while completely ignoring a structural 4.2% inflation rate is arguably the riskiest trade on the board right now. So the big question you really have to ask yourself as you build your portfolio is this: will you recognize the real return, or are you going to accept a future where you are nominally wealthy but functionally poor? Thank you so much for exploring the data with us today on this explainer. We'll catch you next time.